Hello and welcome to Business on the Wire. By the turn of February, something had gone very wrong for India's equity markets. The seemingly immune asset class was falling viciously. Volatility was high and traders were nervous. Has the golden run for stocks taken a big turn? In 2020, the Nifty has already lost close to 20%. The actively traded and tracked Bank Nifty is down even more than that. And the mid-caps, which struggled through most of last year, continue to bleed. So what's hit the market and sentiment this hard? Let's walk through the number of problems at hand. Over the last month, most global markets have posted their biggest falls since the 2008 financial crisis. An emergency cut by the Fed and successive central banks seem to have fallen by the wayside as markets continue to price in the worst. At first, India remained an outlier as it watched, albeit nervously, for signs that the coronavirus had reached its shores. The first blow came with the confirmation of cases from cities like Delhi, Hyderabad and Jaipur. And then the tap was quite literally flowing. With every spurt of confirmations, the market fell. Behind the obvious trend of falling with global markets, here's why the coronavirus impact on India is more complicated. In previous pandemic fears like SARS in 2003 or Zika through 2015 and 16, the Indian economy was in a different space and place. India's growth was at 7.6% in that 15-16 period, the fastest in 5 years. There were enough shock absorbers in the system to absorb global heat. This time, growth is not just weak, it's on its knees. Fresh knocks could prove lethal to an already vulnerable situation. The World Bank, in fact, sees global economic growth in the first half of 2020 likely falling short of the 2.5% pace it forecast for the full year, and India may certainly be part of that collateral damage. Fitch has also cut its India targets down to 5.4% in FY21. For the second time in less than a month, Moody's has scaled growth for India down to 5.3% from the previous 5.4% for 2020. One may argue that in the past the market has shrugged off worries on the economy, but the problem for the market now is to find a shoulder it can lean on to support its growth rebound hypothesis. Analysts now see downside risks to the overall earnings of the market and of the metal and mining, oil and gas and consumable fuel sector through lower global commodity prices and profitability. Add to that aviation, tourism, consumer durables, many other retail companies. Not a lot left to ride on. It's also worth mentioning that it is probably the darkest phase that Indian automakers have lived through. Sales continue to slide, export markets for parts and sales have dried up, and job losses continue unabated. Bear in mind, the auto industry contributes close to 7.5% to the total GDP and accounts for half of the manufacturing GDP. There's another key protagonist in the tale: oil. The global stock market meltdown comes amidst an increasingly bitter standoff between Saudi Arabia and Russia over oil production cuts. The spat has sent oil prices crashing. Expecting a fierce and protracted oil price war, in fact, Standard Chartered has slashed its oil price estimates for this year and next, saying WTI crude prices would average about $32 to a barrel in 2020. That's good news for India as an economy, but bad news for the two pillars that were helping the market along, Reliance and ONGC. Two other glaring problems continue to rankle: currency and jobs. After stabilizing for a while, the Indian rupee has taken it on the chin. Levels of 75 to a dollar are of course being circled. Overseas investors have been dumping sovereign bonds and selling in equities on a fairly consistent basis. On the 9th of March, for example, FIIs sold close to 6,600 crores worth of shares, the biggest single-day outflow since November 3, 2017. They've already sold close to 20,000 crores in March, and that's in addition to 18,000 crores sold in the previous 2 months. That's one. Unemployment remains India's Achilles heel, and that's two. February unemployment figures hit a 4-month low. CMI data shows that India's unemployment rate rose to 7.78% in February. That's the highest since October last year, and it's up from the figures in January. In rural areas, the unemployment rate actually increased to 7.37% in February, all the way down from 5.97% in the previous month. So where does that leave the economy and the stock market that has been through a rather hellish week? Joining me now to discuss all that is N. Jayakumar of Prime Securities, who looks at the equities very carefully, of course. Jakes, thanks very much for joining in. The Ides of March have truly hit us, and it feels like the mood has gone from panic mode into pure hysteria. How would you define what's going on with the market right now?
I think the way I look at it is this is just a market that was crying for correction, but then has now been taken over by machines and stop losses and multiple levels being knocked off, and it's just become one absolutely sort of mindless unwinding of positions, because that would have been courtesy easy money over a period of time. Leverage in the system had built up quite a bit. And I think that's the leverage where every asset class is unwinding. I mean, if crude can come off from 65 to 35 in a matter of 4 weeks or 6 weeks, and gold was supposed to be the safe haven, that's come off $150. But that's not even half the story. The way equity markets that were fueled by easy money policy right through, low interest rates, and we had approximately, let's say, 8 weeks ago, this very curious situation that stock markets were at all-time highs, gold was at an all-time high, you had yields bonds at all-time highs, yields at like all-time lows, negative yields included. And we've never had a situation where these kind of things have, the confluence of all this has been in a manner that I've just described, which means each of this hitting new highs. It's never been the case. So obviously something extremely weird was going on in the markets. And because the markets had been so intoxicated by easy money that you had this absolute asset bubbles being created everywhere. And therefore, when the correction happens, the baby and the bath water, including the bathroom, everything is kind of thrown out. And that's what you're seeing right now. You're having a complete kitchen sinking of every asset category because brokers can't hold positions, margin calls galore, people don't have money, any kind of leverage of any kind. I mean, when was the last time we saw State Bank of India go from 330 to 210 rupees in a period of 4 weeks? I mean, these are absolutely unreal moves. And these indicate a complete capitulation of every investor, every asset class in a manner that's not been seen. And it's possible that you may have one sharp correction, let's say in one asset category, and it bounces back. But after what happened in oil, this kind of stuff is possible anywhere. And that's what the markets are telling you. So for those, many of us who believe that 11,000 was a good, strong base, 11,000 seems like Alice in Wonderland right now. It's so far away. So I think it's a very, very cruel awakening to the fact that leverage in the system, to whatever extent as a result of easy money, had just driven valuations up, or more importantly, value up, and prices had just attained proportions that they just couldn't sustain. So the moment something came as an excuse. Now, to my mind, I don't think this is necessarily the virus which is the excuse, but it's become the excuse. And everyone now is monitoring every day, number of people affected, number of people died, how many countries in the, in the sort of race to be one more addition to the coronavirus victims kind of thing. But yes, it's taking a life of its own, and that's a worrisome thought.
You make an interesting point, Jakes, because I think that's what people felt most nervous about last year, that the market seemed to be running on empty and yet it didn't stop running. Let me ask you this question, in two different parts. One is the technical part of things. How much more unwind do you think there is in the system? And the second really is based on gut, on how much more downside risk you see. I mean, I know it's a facile question given the conditions, but where do you see this panic sort of easing out and people just getting to that state of exhaustion where you almost sell yourself out?
Well, I think what you're seeing here is as somebody quipped on social media that the virus may not kill as many people as the stock markets or the financial markets do. And I think therein lies the truth, that 2 or 3 days here, the markets tend like they've overshot. I mean, this is the rise of, I don't know how many years, which has been unwound in a couple of weeks. And that is the cruel part of this. that today, as we sit and speak, the Nifty is closed on 9,600. And I personally believe we saw 9,600, if memory serves me right, a few years ago, 3, 4 years perhaps. I'm not sure. Maybe more. But and even the last time we came to these levels, we bounced off 9,900. So we've in a sense made, we've hit multi-year lows. I mean, there are stocks that have hit 15-year lows, like BHEL has hit a 20-year low, etc. So this is a complete and true capitulation, and it's bloodletting of the highest order. And as somebody else again quipped that, you go out and buy when you see blood on the streets, but if it happens to be your own blood, what do you do? And therein lies the rub, right? So we can all sit and pontificate here that you must chip away and buy, but I dare say that people are burnt, and this, markets have become progressively lighter, but the capitulation has really, really, shed a lot of positions. And while I don't have an answer to your question as to how much further is there to go, I dare say I would like to believe that we are probably 3, 4%, 5% away from a bottom. Maybe 9,200, maybe 9,400, maybe this was the bottom. But clearly, if anybody has been there who's like Rip Van Winkle, had a 20-year sleep and has suddenly woken up and he says, or 5 years ago he's gone to sleep and says, it was 9,200 when I was not unconscious. I wake up, it's now 9,500. What do I do? And he's missed out the entire party in between. The way I would say is that this is probably a good time for him to start cherry picking. There's a lot that's there. Of course, in the interim over the last 4 or 5 years, you've had multiple corporate debts, and I think therein again is the new story of India, that you do business properly or you're cleaned out. And the kind of cleaning out that's happened has just been, spectacular, for want of a better word.
So it has. This has been the nature of corrections in the past few years, though, Jakes. Very sharp, very intense, but on the positive side, a bit short-lived. Do you see this one as dragging longer, and what shape do you think the recovery might take? I mean, it looks unlikely that we are heading for a V, but what shape do you think dragging out of this mosh pit is going to look like?
I'd like to believe the recovery will be a V-shaped recovery and then a gradual plateauing out, because it's not possible that people will get a chance to sort of all buy, and we have a long protracted kind of thing. Of course, people will be quick to remind me that we have no resolution as yet of the virus and its implications. So, is it that we are heading for? So, even for instance, in Prime, in our own office now, we have 3 or 4 offices. We only have that manned by maybe 1, maybe 2 persons a day, and the rest work out of home. So, the social distancing, as the new buzzword is catching attention and sort of phraseology, social distancing is now happening. People are more and more inclined to work out of home. And as advisors, investment bankers, our clear direction is, if there's a meeting, try going personally. If you can't do this on the phone or on Skype or any other sort of medium, and travel is completely out, whether overseas or domestic. So suddenly we're putting all these kind of embargoes, and in that sense, we are a small company, 25 people, but only 4 people or 5 people come to work every day. And if this becomes the norm, already, if the world believes that it is incapable in the short run of handling an outbreak of this kind, biological in nature, then is social distancing, which means actually doing this off-site, working out of your own little cocoons. This, at least for the next few months, is going to be the norm. All conferences are cancelled, wedding receptions have been cancelled. So there is an absolute collapse of the way we've been doing things that's coming through. And what technology is doing is, it's ushering in these changes almost instantly on you. It's saying, if you see some of the social media posts on the folks from Italy, for instance, they talk about how what needs to be done has to be done now. What needs to be done has to be done as of yesterday, not even as of today. That the world was actually complacent in its own ability to handle something like this, and has been rudely sort of disturbed. So I, for one, do not believe that this is a longer term issue, but who is to say that 15 days is not long term? because it's like every single day there are more and more stories. There are the Trumps of the world reacting in a manner saying, cut off travel between Europe and the US. But these kind of things happening, these are all very seminal changes to the way we've seen business and life being run. So,
Absolutely.
so I think it's a very sobering kind of day.
Of course, that changed work view works for everyone else but newsrooms, Jakes. Apparently, in proximity, we trust, so we'll have to just keep our fingers crossed. But, the sucker punch for equities, Jakes, came with what happened with the crude market, which was really, red hot panic. What do you make of that, and how much of a silver lining do you think this will eventually become for the Indian context?
I think crude is in a seminal bear market. My own personal feeling is that crude could, trace much lower levels. But having said that, the Indian government, and that's the takeaway that we should be looking at. I think the number is for every $1 cut in crude, we save $1.5 billion per year. So for a $30 change, if 65 was our budgeted rate as per the budget, therefore the budgeted rate, at 35, we talk about $45 billion a year saved. Your entire divestment program doesn't generate this kind of saving. Your entire, all your various schemes that you wanted to put into play, literally, if you could close out your 1 year's requirement at $35, notwithstanding the fact that it goes even lower. If 35 then bounces off to 45, 50, you're lucky that you covered it all. But if you're trying to optimize on the other thing, I have no doubt that we'll see $20, $25 on oil. But I think let that be gains for the future. We should, especially in the kind of scenario that we're in, use this $40, $50 billion to seriously reflate the economy. I have actually talked about how strategic petroleum reserves need to be built up. And whether this is not a play on the spot on the futures market, this is not paying a premium and trying to lock in the rate. This is actually buying physical oil or contracting for physical oil and closing out your requirements for the next 6 months, 9 months, 12 months, and take in this $40-45 billion of saving. It's a huge change. It's a huge saving to our to the national budget, and I think this could have massive implications on what they could do for the country at large with this kind of saving.
Where does all that leave the stock market though, Jakes, which is frankly at this point grasping at straws in terms of some shoulders to lean on earnings wise? Because this means bad news for both Reliance and ONGC. We've seen what's been happening with retail, with telecom. Autos, of course, are the saddest story here, and now it looks like there's a bunch of other smaller, sidebar sectors that also get pulverized in this, which is like tourism and retail. So, who do you turn to for earning support in this context?
So, if there's a silver lining in this, as I said, is the silver lining is straight away to the government finances. Sure. Number one, and that's big. Let's not even say there is no single item that will contribute 300,000 crores to the government as this one will. Number two, one thing is very clear: Reliance is keen to deleverage itself. It's probably not going to be able to do that Aramco deal in a hurry, as I see it. Having said that, one of the things or the offshoots of this is the fact that they will not cut any more on the telecom, the tariff rates, which means that you actually are looking at 3 players surviving. So the telecom industry may actually see better days ahead with some government support, with some navigating through the Supreme Court, set of diktats, as if you will, in terms of collecting the revenues, etc. I think they'll get more time, and I think the telecom sector may well be the sort of beneficiary, and specifically 1 or 2 companies in that will benefit much more than the third one, simply because they are at the receiving end of the AGR right now. So that's one sector. I think a lot of sectors in the short run may face the problem, but I think it begs the question. I think pharma is an extremely well and attractively valued space, and that's something that I think we will continue to focus on from an investment perspective. And other than that, while, as they say, it's darkest before dawn, and while we're doing this interview at 4 p.m., it does seem reasonably dark outside. But having said that, I think, when it seems, that everything is finished is when a new beginning comes in. And I think people today, I think there's a complete, total aversion and apathy towards the stock market. And I think that's what's going to create a new beginning and a new set of leaders in this as it were. So I think interest rates can go down significantly and dramatically. So the long bond is, probably trading the six handle. I think it could easily trade in the maybe even in the sub five handle. So there's 125 basis points that could go. And I think the flow of foreign money, which has got completely disrupted to the stock market, may well be attracted by the valuation changes. And ultimately, because you're living it, you feel that this is the end of the world. It never is, right? I mean, the markets go way, way beyond all this. And we've seen similar things in the past, but unfortunately, technology amplifies these changes in today's world. And I think that's why it looks bleaker than otherwise.
Do you expect our own central bank to step in as well and ease up things on the rate side, as many other banks have across the world?
Absolutely, should already have. And I think we can't make a virtue out of just them saying they're being conservative by staying away, seeing various numbers. A lot of things are happening. These are all, I think, almost near permanent damage to things like price of oil. There's no reason why they should be still waiting in the wings to figure out if inflation is there or otherwise. Number one. Number two, even SEBI can make a few changes. Again, I've tweeted about it, which is things like why should promoters be allowed to buy only 5% a year? Why can't they buy 10%? If there's a promoter who has money, who wants to buy more of his stock, benefit small investors that he increases holding by 10% in a year, why not? It can, I mean, it's completely legit. And today it's not legit that you can't go beyond 5% a year in terms of increase of holding. The third thing, of course, is this thing about buybacks. Two buybacks must have at least 1 year separation, which means that after the completion of a buyback, you need 1 year before you can do another one. What's to say the company steps in and buys more? Good for the small investor. Why should SEBI have a problem with that? So there are regulatory changes that can help the markets. There are government interventions that can help the markets. There are RBI interventions that can help the markets. So I think whether RBI, the government through the fisc or through these regulators, I think there are interventions galore waiting to happen. Now, they say a week is a long time. From here, we see it as almost a day is too long in the markets at times. And the fact that we have not heard anything from any of these parties I mentioned is not particularly great news.
While the pandemic has certainly been global in nature in terms of its impact on markets, Jakes, I think the first, brace for impact happened with the Yes Bank episode. How do you see that resolving itself? And do you think we're headed to the same kind of credit lockjam that we had post IL&FS?
My own assessment is the Yes Bank saga is virtually done and dusted. We really need to see the balanced set of investors. SBI has just announced that their ECCB has cleared 7,000 odd crores. I'm sure there are matching investors who will come in. So I don't for a moment believe that we need to worry too much about it. Yes Bank will take a life of its own and move on. We just hope that there's no run on deposits, which hasn't been even during the worst of times. Now with SBI being there, unlikely that's going to happen. But does it beg the question that there are other private sector banks that need capital? I think it does. And maybe those will pop up once in a while, but none larger than and none more important in a sense than Yes Bank being resolved. I think at least the markets should have found their feet with that resolution. But unfortunately, while that happened, this virus bit has, set in motion a panic of a very high order.
For a couple of years now, Jakes, the de facto return generator has certainly been, investing in the stock markets, inflation adjusted as well. You mentioned earlier that you expect to see a V-shaped recovery and then a plateau. What is it that you see the market generating over the next couple of years? And do you think some of that golden era might come for, a break or a halt over the next few months and years?
I think the market's like a spring. It's been, I think, pushed too far. So can 9,200 be hit 9,400? Sure, it can. I mean, this is what momentum can take it. But I think the bounce back would take it to the 10.5 range. And I think that bottom, so that may be the area of consolidation is what I personally believe. And I think, these are assuming that a resolution happens quickly. But until then, if there is margin calls and all sorts of redemptions worldwide, then these things could take a life of its own. But having seen corrections like this in the past, my belief is that a 10-10-5 is a reasonable base at which a lot of good value can be unearthed in the markets. And we have, as we speak today, seriously overshot that.
Let me ask you this question another way. Are you buying gold?
No.
And would you if it corrected?
I think people, there are too many bulls in the world in gold. And if by now it had to be a trade which is not a consensus trade, it would have been probably $2,400 by now. The fact that I've seen more gold bull reports over the last 1.5 years, and all that gold has done is moved up from 1,300 or 1,150, 1,200 on the low actually, towards 1,700, now 1,630, 1,640, indicates to me that it's been a safe haven in the sense that people have parked their money there, but there's few central banks selling. And I think as more and more gold holdings get liquidated, that money will come back to reflate economies. So I think the money that's been parked in gold by central banks will actually be used for, in some sense, reflating their own economies. So I would not be a buyer in gold, not for some length of time.
I hope you answer me candidly on this one, Jakes, but how is Bombay feeling about what's happened in Delhi so far? We've been through 2.5 budgets now, or 3 if you want to call it that, which have either veered towards doing nothing or actually doing something harmful for the stock market. The feeling seems to be that the government doesn't quite have economic management in place. Is there greater concern about India in that regard versus what the other stock markets are suffering at this point?
I think the management of the economy is way up there in terms of priority as far as the government is concerned, not just stated, but even in terms of the frequency with which they come and address issues. I must say one thing, that the government has been seen to be responsive, as in they hear out everyone, is what I get the feeling. I mean, I myself have had this thing of being able to tweet, and I think many of those suggestions do get considered. I have no reasons to believe that the government doesn't wish to do what it states it wants to do, which is reflate the economy. But we, whether in South Bombay or South Delhi, shouldn't get confused for economy, the management of economy being concomitant or equivalent to a buoyant stock market alone. The stock markets need to be buoyant, no question. But is the buoyancy in the stock market and the stock market positive response every time the only yardstick? I think the answer is no. I think they've got a lot of social agenda on their plate, which they want to put together. But perhaps they haven't realized, this is what I feel, perhaps, that the stock market, large-scale divestments can actually be bigger game changers in their bid to raise money for the economy than anything else. Today, for instance, just the ability to handle the surplus that gold creates, oil, the savings in oil creates, plus some strategic divestments, because the government just can't manage enterprises. That's very, very clear. So a combination of real big ticket divestments, plus taking with two hands this seminal fall in oil prices, plus tinkering around to some extent with taxation, to eliminate this thing where people now start doing buybacks as opposed to paying out dividends when it was meant to be the same. People view this as one equivalent to the other. There's no sense having these where people arbitrage one from the other, right? That is, instead of giving dividends, they do buybacks, etc. I think longer term, they need to simplify taxes. I'm not so worried that the highest bracket is 43%. Maybe it will come down, maybe it won't. I think the government wants to impact a larger number of people. But I think the realization that a larger number of people are putting money into mutual funds, and therefore it's integrated the stock market and the health of the stock markets, etc., is a realization that's only come or will come over a period of time. I think increasingly, we must not take stock market reaction to be the yardstick of government performance. And I think that's something that's important.
For a while,
Otherwise,
yeah.
Otherwise, we'll be leading ourselves up for expectation mismatches and disappointments, which has actually been the way we've come away on a few of these budgets. But what alarms me is the complexity they keep adding to these budgetary provisions. Why should, for instance, individuals have either one with deductions or without? Why should corporates have one with deduction or without? I mean, this makes calculations a nightmare and actually increases the possibility of tax terrorism in a very loose general way. There's no reason to keep it simple. Your objective, if it is to pass on a tax cut, give the tax cut. If it is to raise taxes, raise it. But let us not, we don't need to sort of go around the hoops trying to figure out if I put in 20,000 here, but I don't do this, I treat this way, I change the methodology of doing it. Why do we have to get into all this? I think at the end of the day, yes, our tax collection is poor compared to the economy and the GDP, for which you need to raise certain taxes. I think one way is compliance. And it's been seen that as you lower tax rates, compliance improves. We need to get back onto that path clearly. Having said that, they will turn around and say that for new businesses and for without any deductions, the rates have come down to simple 15% or 25% or whatever. I think if it can be seen in that context that they're actually passing back or giving tax cuts, you will see that impact coming through. The problem has been people have not seen the benefits flowing through. And two, many a time I think there's a discordant note between what the intent is and what they end up doing. So I get the feeling that maybe a few more voices from the practitioners need to be heard. I think a larger forum needs to be done, and speed of response needs to be quick. I mean, if the president of the US can literally, at the drop of a hat, either tweet or come out and announce policy, I think it can be done here. The process has started here, with the FM having done multiple of these 5 o'clock evening press conferences, making life that much more exciting for your ilk, where I think speed of response is important. And to that extent, I say, whether it's the RBI, whether it is SEBI, whether it's the government, they all need to move now very, very quickly. Otherwise, this is the markets today envelop not just South Bombay, South Delhi, and a few from the other cities. People's wealth through SIPs, etc., is in a major way in stock markets. And I think it's a matter of some concern that, that we need to look at it. And I personally believe with oil at $35 and our markets collapsing, this is not a picture that is tenable. Mm. And I don't think oil goes up. Therefore, I think by definition, markets are undervalued.
Jakes, I remember speaking to you in 2008 where you described the market as when she's good, she's very good, and when she's bad, she's horrid. So I'm sorry to have spoken to you in horrid times, and I hope things get better, but I do appreciate your time. Thank you very much for joining in today with your thoughts.
Thank you. Thank you.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.